The moment Bitcoin stops being created might be the moment it becomes unstoppable. And if you understand why, it completely changes how you see Bitcoin. There's a date on the calendar around the year 2140 when the system that mints new Bitcoin just stops. The common fear is simple. Without mining rewards, the miners leave and the network collapses. But this isn't a flaw, it's the plan. The end of mining isn't a bug, it's Bitcoin's ultimate feature. The final step in creating an asset of absolute scarcity and the very thing that could make it more valuable than ever. So let's tackle that fear head on, because it seems logical. Right now, miners are the heart of the Bitcoin network. They are the decentralized accountants and security guards all rolled into one. They commit massive amounts of computing power to solve a complex cryptographic puzzle. The winner of this race gets to add the next block, a batch of recent transactions, to the permanent record, the blockchain. But why do they do this? It's not out of charity. For this crucial service, they get paid in two ways: a block subsidy of new Bitcoins and all the transaction fees from the transactions they include in that block. But here's the part most people miss. That block subsidy, which currently makes up the vast majority of their income, is designed to disappear. It began at 50 BTC per block, but it's programmed to get cut in half every 4 years in an event called the Halving. This decay is a core feature designed to control the creation of new supply. It will continue until around the year 2140, when the reward finally becomes zero and no new Bitcoin will ever be created again. And that brings us to the core of the fear. If the main payday vanishes, why would anyone spend billions on specialized hardware and electricity for just a handful of fees? If the miners turn off their machines, the network loses its security. That computing power is what makes the network resistant to attack. Without it, a malicious actor could, in theory, gain control of more than 50% of the network's power, a 51% attack, and start to corrupt the blockchain, blocking or even reversing transactions. Imagine a digital ghost town. Transactions would slow to a crawl and then stop. Confidence would evaporate. The very trust that gives Bitcoin its value would be gone. It's a valid concern, and at first glance, it actually looks like a fatal flaw. But it overlooks the genius of the design. And this is where the story gets interesting. The end of the block subsidy isn't a surprise bug that no one thought about. It's the system doing exactly what its creator, Satoshi Nakamoto, designed from day one. The protocol was built from the very beginning for this precise transition. Think of it like the booster rockets on a spacecraft. They provide the enormous, almost unimaginable thrust needed to break free from Earth's gravity and get the ship into orbit. They burn through immense amounts of fuel, but they are absolutely necessary for the initial phase. But once the ship reaches a stable orbit, the boosters fall away and a more sustainable long-term engine takes over to guide its journey through space. For Bitcoin, the block subsidies were that initial fuel. They were designed to bootstrap the network, providing a powerful incentive for miners to join and secure the system during its vulnerable early decades. By 2140, that fuel will be gone. The network is engineered to be mature enough to fly on its own, powered by a completely new and more sustainable engine: transaction fees. Here's another way to look at it. Imagine building a massive skyscraper. For years, the structure is surrounded by a web of scaffolding. That scaffolding is the block subsidy. It provides the support needed to build the tower floor by floor. But once the building is complete and its own internal structure is sound, the scaffolding is removed. The building doesn't collapse, it stands on its own, finally revealing its true form. This is what Bitcoin is designed to do. Most people see the end of mining as a sudden cliff, but in reality, it's a slow, 130-year handoff designed to keep the network secure every single step of the way. But a new engine isn't enough without one crucial element. And this is the part that changes everything. This brings us to the heart of Bitcoin's value proposition: absolute scarcity. Once the last Bitcoin is mined around 2140, the supply is fixed forever. a maximum of 21 million, not one more. This is a property no other asset in human history has ever truly achieved. Let's compare it to other things we consider valuable. We think of gold as scarce, but its scarcity is relative. If the price of gold skyrockets, mining companies will invest billions to find new veins, develop new extraction technologies, and pull more of it out of the ground. The supply of gold increases every single year, and there is no knowable final cap. Now, compare it to traditional fiat money, like the US dollar. There is no supply cap at all. Central banks can and do create more money at will, with no theoretical limit. This is what leads to inflation, where the money you hold buys less over time. Even stocks aren't absolutely scarce. A company can decide to issue more shares, diluting the ownership percentage of every existing shareholder. Bitcoin is different. Its supply isn't just scarce. Its scarcity is absolute and locked by mathematics. No matter how high the price goes, no one, not a company, not a government, not even Bitcoin's own developers, can create more. This isn't a policy, it's a law of the network, enforced by thousands of computers around the world. And here's what most people don't realize. We are already living in an era of extreme Bitcoin scarcity. Over 95% of all Bitcoin that will ever exist has already been created. Factor in the millions of coins that are believed to be permanently lost on old, inaccessible hard drives, and the true circulating supply is even smaller. The end of mining in 2140 isn't a beginning. It's the final, absolute stamp on a process that's already here. It's the moment the asset becomes perfectly finite. But scarcity alone doesn't guarantee security. This sounds good in theory, but there's a problem critics always point to. So let's pause, because this next part is where most people get it wrong. If the main reward, the block subsidy, is disappearing, how is the network actually supposed to pay for its own security? If absolute scarcity is the why, then transaction fees are the how. This is how the network stays secure long term. As block rewards predictably fade to nothing, miners' income will shift to being 100% from the fees users pay to have their transactions processed. It's not a donation, it's a market. Think of Bitcoin's block space as digital real estate. Every 10 minutes, a new block is created, and it offers a limited amount of space for transactions. To get your transaction included in that block, you have to bid for that space with a fee. Let's use an analogy. Imagine a cargo ship that leaves port every 10 minutes, bound for an immutable destination. The ship has a fixed amount of space. Anyone who wants to get their package on that ship has to bid for a spot. If the ship is nearly empty, you can get your package on board for a very low price. But if thousands of people are trying to ship valuable goods all at once, they will start outbidding each other. The ship's captain, the miner, will naturally fill the limited cargo hold with the packages that paid the highest shipping fees. This is the fee market. Miners, as rational economic actors, will always prioritize the highest paying transactions because it maximizes their profit. This creates a competitive market where the cost of a transaction is determined by supply and demand for block space. When demand to use the network is high, fees rise. Higher fees make mining more profitable, which attracts more miners. And as we know, more miners means more computing power, which means more security. But here's where the theory meets its biggest challenge. Will fees really be enough on their own to secure a multi-trillion-dollar network? That is the billion-dollar question. The answer depends on a different kind of demand than what we see today. It's not about buying coffee. It's about a demand for high-value, final settlement. People don't use a Brinks armored truck to deliver a pizza. They use it to move gold bars. The Bitcoin main chain is built for the gold bars. Large, important transactions where paying a premium for ultimate security is the entire point. And that leads to the real takeaway. A fee market only works if people are actually using the network and are willing to pay for that block space. The entire thesis for a post-subsidy Bitcoin relies on one core belief. The demand to use the network is set to rise for decades to come. And there are powerful reasons to believe it will. Because if that demand doesn't show up, none of this works. First, institutional adoption. The launch of spot Bitcoin ETFs has fundamentally changed the game. These aren't just new ways for individuals to buy Bitcoin. They are regulated, insured, and familiar financial products that have unlocked the door for trillions of dollars from pension funds, endowments, and corporate treasuries to gain exposure. These large institutions, who were once hesitant to deal with the complexities of direct crypto custody now have a bridge into the asset class. This wave is just beginning. Second, Bitcoin's evolution into digital gold. In a world of perpetual money printing and currency debasement by governments, a provably finite, seizure-resistant asset becomes an incredibly powerful safe haven. It's not just for individuals. The same properties make it attractive for corporations and potentially even nations looking to diversify their reserves away from traditional currencies. Finally, and this is crucial for the fee market, Layer 2 scaling solutions like the Lightning Network. These technologies are built on top of Bitcoin to handle millions of tiny, instant transactions off-chain for extremely low fees. Think of the Bitcoin blockchain as the main, ultra-secure federal highway system. It's robust and reliable, but it isn't designed for you to drive to your local corner store. Layer 2s are the local city streets. You can make countless small trips quickly and cheaply on these streets. Then, only the final settlement of all those trips needs to be broadcast back to the main highway. This doesn't replace the main chain, it elevates it. It allows the main blockchain to be reserved for what it does best, settling large, high-value transactions where paying a premium fee for absolute, irreversible security is the goal. And this is where this stops being a theory and becomes something you can see happening right now. This brings up a critical point. The year 2140 is over a century away. Why does any of this matter now? The reason is that financial markets are forward-looking. The end of mining isn't a distant academic problem. It's the foundation of the investment thesis today. And we are seeing dress rehearsals for this transition play out in real time. They're called the halvings. Every 4 years, when the block subsidy is cut in half, the network is forced to rely more on transaction fees. Each halving is a scheduled, real-world stress test of this exact economic model. So far, the Bitcoin network has not only survived these periodic revenue shocks, but its security and value have consistently grown stronger in the periods that follow. The halvings act as a slow, steady ratchet, pushing the network closer to its final form and proving the security model's resilience along the way. From an investor's perspective, this long-term vision is paramount. Institutions and serious investors aren't just buying Bitcoin based on short-term speculation. They're making a bet that this elegant, long-term economic design will succeed. They see the program Scarcity and the transition to a fee-based security budget not as a risk, but as the very mechanism that will ensure its longevity and preserve its value. The price of Bitcoin today is in many ways a reflection of the market's collective confidence in a future that was designed from the very beginning. So the end of Bitcoin mining isn't the end of Bitcoin. It's its graduation. It is the moment it fully transitions from an incentivized startup into a mature, self-sustaining economic machine. A finished monetary good with a perfectly rigid supply that no other asset in history can match. The fear of collapse comes from a simple misunderstanding. The system was designed for this exact moment. The bet is that absolute scarcity will meet rising global demand, while a thriving fee market, supported and amplified by new layers of technology, will secure the network forever. The real shift isn't a date on a calendar in 2140. It's the moment the world realizes what that date actually means. And as capital flows into this asset, that realization may already be priced in faster than most people expect. If you made it this far, you understand Bitcoin's long-term economics better than most. If you want simple, no-hype breakdowns of how this technology actually works, make sure you're subscribed. And I have a question for you. What do you think will be the biggest driver of Bitcoin's demand in the future? Let me know in the comments below. Thanks for watching, and by the time everyone understands it, it may already be too late to benefit from it.